Hi, I'm Merryn Somerset Webb. Welcome to another MoneyWeek video. I am here today with Gary Channon, who is one of the co-founders of Phoenix Asset Management in 1998 and has been the manager of the Phoenix UK Fund ever since. Now, this is a fund that most of you won't have heard of because it's really only open to very large investors, but it has a phenomenal performance record, an average of just over 12% a year since launch,
yeah, 12.5%.
which relative to the FTSE as a whole is rather good. So we're going to talk a little bit to Gary about how he's done this, what his investment principles are, and then we're going to talk a little bit about a new vehicle that he has that actually the likes of us may be able to invest in. So, Gary, tell us a little bit about how you invest and how you've come to this rather impressive performance record.
Well, I suppose we spend a lot of time finding the right sort of companies, and we sort of separate finding the right companies from when we invest. So we, in our sort of process, very simply, business, management, price, we try to find double A's, so the right business and the right management, and then we wait for the right price.
Okay, what makes the right, let's start with the right management.
Okay, integrity, first and foremost, so that's what we look for. Competence, so we're not looking for great managers, we buy great businesses, so we want them to not mess them up. So competent at running them, but then aligned. We need them to be allocating capital in ways aligned with our interests. So those are the three key things.
So you want them to be owners and investing capital for the long term?
Yeah, or thinking like owners, or acting. I mean, the way that they're incentivized is in line with us. Either they own a stake, or they're founders, or the way that their remuneration is set up aligns them with shareholders.
Okay, so they don't hold a whole pile of options that vest after 2 years of super high short-term profits?
Yeah, that type of thing.
That would be bad.
Yeah, that'd be bad.
Okay, good. So that's management. The right kind of business?
So, I mean, we have a whole manual for how you do this, but the key things are high return on capital and pricing power. So it's really, really hard to I mean, most of the businesses we look at, we throw away, so we can't value them. So in order to be able to, for us to be able to value them, there needs to be some sort of predictability in the sort of the future cash generation, and the way that might come is some form of pricing power. So some sort of franchise. It might be that they've got a consumer franchise or brands or some form of oligopoly or strong market position, but we need that, and we need the high return on capital. The high return on capital is sort of, in some ways, a proof of how strong the franchise is, how predictable it is, how defendable it is, and also the economics of high returns on capital work very well for us. So, but the other key ingredient, which is probably slightly different for us, is the transparency. So we sort of view all our businesses through the eyes of their customers. We mystery shop them. So we only invest in things that we can put someone in the field to see the business in action. So that's our real risk management. Most of what we do in the office, 2/3 of the work, is testing our businesses in the field.
Okay, so you can't really invest in something that you couldn't mystery shop for?
Yes. So, we can't buy Rolls-Royce because even Rolls-Royce doesn't tell you what they sell the engines for, and their customers don't tell you what they sell the engines for. So we wouldn't be able to see whether they were doing well until we had the profit warning.
Okay,
so,
and you're not prepared to go out there and pretend that you're in the market for 10 jet engines?
We've tried. We've been to conferences, we've been to trade shows, and we tried because it has a lot of other characteristics that we like. But we can't monitor it, and if we can't monitor it independently from management, we don't invest. So yeah, there are a lot of businesses that are like that, especially in the business-to-business space, where we can't put ourselves in the. We want for a business to earn a high return on capital, the customer's doing something. Why can't they go to an alternative? Why? And if we can see why that is, and we model it, and then we go and test it. If it changes, hopefully we'll spot it early.
Okay, but this is a process that suggests that you might find yourself heavily invested in consumer-facing industries at the expense of others.
Yes, and that's true. But there are business-to-business ones where you can monitor it, or where there's enough in the public domain that you can see. I mean, we test the transparency and saying, what can we see? Can we see sales? Can we see profitability? Can we see market share shifts? So there are business-to-business companies where that's the case. But yes, but also when you supply in a business-to-business space, quite often you shouldn't earn an excess return on capital. Businesses are quite rational in their spending. Yeah. Humans are much more emotional. So a lot of the best franchises are consumer-facing because the purchase reason has got something to do with human behaviour. And so I don't think we miss much in that sense.
Okay, so that's business and management. And how do we look at price?
So price, we want to pay a price where on our sort of downside scenario, on a sort of stress test, we get our money back. So we don't want to lose our money. That's the bottom price. And then we take a sort of central expectation. We model cash. We don't model earnings. Discount that, and we discounted at 15%. And essentially, we don't want to pay any more than half what we think it's worth. Okay. So 50 pence in the pound is the sort of the highest price we'll pay. So we take out all gearing. We don't want a risk of ruin. Okay. So we assume that we pay off the debt and we pay off the pension liability up front, but we wouldn't buy a business where cyclicality or some sort of swing would take it out, because we make a very, very focused portfolio, so we can't have any zeros.
Okay.
So,
and do you specifically look for low debt businesses?
I mean, low risky gearing. So it doesn't have to be low debt. It's just the debt shouldn't imperil the business. So some businesses with small amounts of debt are imperiled, and other businesses can take decent amounts of debt and not be imperiled. And sometimes there's an illusion that things look imperiled, like house builders say, and but we wouldn't invest in them if we thought there was a risk of.
Well, I remember actually you were very early to house builders, weren't you, in this cycle? I remember having a conversation with you about it and thinking, geez, I don't know, it sounds a little dangerous going into house builders now. This must have been when?
2008.
2008, yeah, and I was very uncertain about this, and you were very firm on it, and presumably you made a killing. Yeah,
we did well, because we've been investing in house building now for sort of 17 years, and we look at it in a very, very different way. If you look at it through the way we look at it, it doesn't look so risky. Through accounting earnings, it looks horrific. But I mean, we invested in Barratt. They came into the credit crunch with 1.2 billion of debt, but they were spending $1 billion a year on land. So the moment you stop buying land, you generate loads of cash. They came in with $1 billion of work in progress, so already half-built houses that then again turn into cash. And then we were mystery shopping at that point about 250 of their sites. So we knew they were selling 200 houses a week. So we could see the money was coming in. We talked to management. All we got.
Because you, the agent's worst nightmare, going to visit show home after show home after show home, and never actually coming up with the money to buy a house.
That's why we have to cycle people. So we use lots of relatives, and because eventually, it wears thin when you haven't bought. So we sort of rotate and cycle people. So in terms of actually sites we'll visit now, it's about 50, but we strip the rest off the website. You can, if you go to the website and every 4 weeks you take the data off, you can see how many plots have sold. And so we monitor them, Barratt and Bellway in that way, and we have a pretty good estimate of their sales rate. Just by every time you go back, you can see how many plots have shifted. So.
Okay, so which house builders are you holding at the moment?
Barratt and Bellway.
Barratt and Bellway. Yeah, and you're confident with that now, even now?
I mean, this is just a wonderful time to be a house builder. It's not because they can sell houses. They've always been able to sell houses. There's an undersupply, so build the right product. We've got 2 national house builders, so we're not making any sort of London or any kind of regional bias. So in a market that's undersupplied, you build the houses, you can sell them. The price, you have to take whatever the price the market happens to be at that time. But you saw what happened in 2009, 2008. You don't get a much worse shock than that. But there was no overhang by the end of December 2008. It clears in an undersupplied market. The thing that's very interesting at the moment is you've got a lot of government schemes, a lot of government behind, so that's making it very, very easy for them. And the planning system's eased up enough that there's an excess of land. So the returns on house building have become much higher than you'd expect them to be at this point in the cycle. They're still getting deferred terms. If anything, the margins they're buying land at now are higher than they were 4 years ago. And you would have thought after this much run up that wouldn't be the case. And that's really the government's effort to free up land, and the absence of competitors. There aren't any middle-sized.
That's an interesting point, isn't it? A lot of the middle-sized and smaller builders disappeared in 2008, so the competition has rather disappeared, or the local competition.
Every cycle's done that. So since the war, you've gone from sort of 20,000 house builders down to whatever. And the registered might be 11,000, but in reality, the top 10 now are more than half the market. It's an extraordinarily concentrated. It's very hard to be a mid-sized house builder. The small guys tend to work on local knowledge and planning gain, but the scale economies that you need, the environmental standards, all of these things. So when a middle-sized house builder is bidding against a big house builder, its cost to build is so much higher, so you can't afford to bid the same level for the land. Yeah, financing's harder, but I don't think that's the issue now holding back middle-sized house builders. It's those scale costs of being able to, and then labour costs you more because you don't have the same regular amount of work that a Barratt or Bellway can give So yeah, that has happened. Each cycle we've been through in the last 40 years has increased the concentration at the top end. It's not straightforward building houses.
Interesting. Now this is quite a focused portfolio, right? 15,
Yes.
20 stocks. How many at the
15,
moment?
20 stocks, and 17, and the top 5 are usually more than half the portfolio.
Okay, and what's in the top 5 at the moment?
So Barrett's our biggest holding, Lloyd's at the bank. We hold something called CPP, which is something we bought about a year ago, and we didn't put such a big weight in it.
And what does it do?
Car protection plan. So this is an unusual situation where we've effectively provided capital for a business coming out of a regulatory situation. It got stopped from selling its card protection plan. It's sold with when you activate your credit card. So it sort of protects you against losing your credit cards and replaces them. But they were selling it on the basis of all the other protections, which actually you got from the bank anyway if you lost the card. And so they had a mis-selling scandal. They had to then pay back all of that money, which damaged the business. But at the end of that was all finished, and we gave them some capital to sort of re-emerge on the other side of that.
And you're happy with the integrity of the management?
Yes. Well, our chairman is now their chairman, and so the prior management was all gone. The management changed during the regulatory process, and the regulator had to be happy with those changes. And we've emerged with a 40% holding in that company, and we made we valued it in 2 ways. One is we could close it down and make a good return, or it performed well and we make a really good return, and that was the basis. So we like to think that when we do something, we don't go in with any expectation that we're going to lose money, and that was the case here, and sort of more protected by having a big stake and nominating a director.
Okay, so that's the top 3. What shall I talk about? JD Wetherspoons we have, and Sports Direct. Okay, so there's complete there.
Yes.
How much mystery shopping are you doing at Sports Direct?
So we've been involved in Sports Direct since 2007. So in those last 8 years, we probably do 50 a year, and we do UK and we do Europe. It's changed. So at the beginning we were judging Sports Direct versus JJB. They weren't the number one, so we had to go and see how that competitive dynamic. That's what we look for in the mystery shopping. So we go to a cluster, like when we do supermarkets. So I didn't mention Tesco. So, but we have Tesco's and Morrison's also in the portfolio. So we tend to look at an area, say if I'm a customer, these are my choices. So I can go to JJB, I can go to Sports Direct. What's going on? What product can I buy? And how do they compare on price, or how are the staff, and all of these other issues, how the shop. So at the beginning we were testing Sports Direct versus JJB, and then JJB disappeared, and so now we're testing Sports Direct versus any other competitors that emerge. We mystery shop them online, so we basket test them against Amazon and eBay and any of the other competitors, and then we go and visit parts of their European operation. But having made that original investment in 2007 into 2008, they floated at £3, and then we were buying it at £1.50 within 6 months of the float, so it halved, went down to 30p. I think we paid about £1 for our first investment. It then ran to £8. We trimmed it in so 2011 to 2013. We took most of that money off the table, left it about a 3% weight, and now we're buying it 60% lower. It's £3.60 or something, and it's the same business all the way through. This is just the beauty of the market. They hated it. They loved it on the float. They hated it afterwards, and then they loved it, and it went into the FTSE and stuff. And now they hate it, and it'll be coming out of the FTSE. But all the way through, it's an absolutely brilliant team. They're a fantastic retailer, and when you dig a bit deeper, it isn't how it seems on the surface. I suppose a lot of our investments are like that. At the time we make them, they look ugly, but actually when you dig a bit deeper, they're not as ugly as they seem.
Okay, interesting. Well, I'm sure that at this point viewers are beginning to say, well, how do I invest with this genius?
Well, we've made plenty of mistakes. So should talk about HBOS.
You better tell us about one of your mistakes before we move on.
Okay. The very worst thing we've ever done was invest in HBOS, which is now our Lloyd's holding. So we it'd be better if we never went anywhere near banks, but we're drawn to industries where the Competition Commission has looked at them and found that competition doesn't work properly, and the operators earn excess returns, and UK retail banking is one of those. And so
shouldn't that be a danger signal? And that if competition isn't going to work properly, you can expect waves of regulation endlessly.
Yes, but what's good in all those studies, what was interesting is the problem was effectively humans, that people wouldn't switch. So initially they thought, well, it was hard to switch, so they made it easier to switch.
We still won't switch.
Yeah, and then they did it for businesses, and they said, look, businesses think that they benefit by staying with the same bank, and look, we can show you the switching companies pay less. And they even got them, so they had to force banks to pay interest to companies. So this is even companies doing their own purchasing couldn't switch banks. So at the core of the problem with banking, or the excess returns, is this lack of switching. And retail banking, I mean, it's got a bad press, but mortgage lending in the UK has never had a loss-making year. So if you owned all the mortgages in the UK, you've never had a down year. Whereas you can get into trouble because you've focused in a particular area, or you've had the wrong capital structure. But the worst loss was a 90 basis point loss in 89, or it was 40 in the credit crunch. But they're making a 2% spread on mortgages. So the mortgage business is a very nice place to be. Lloyd's is right in the centre of it. And so we had Lloyd's, HBOS as potential alternatives. We invested in HBOS way too early, made a series of mistakes. I suppose pre-credit crunch, I used to think that we were like Columbo. We were getting facts and there was a fixed truth. And once we'd established the truth, we could make our judgments, and the market was fluctuating here, and we would take advantage of that that discrepancy versus the fixed truth. And I suppose I learned something, what Soros calls is reflexivity. So
no fixed truth.
So in reality, the market, the perception can change the reality. And HBOS, there was a perception there was an issue, and the mortgages was part of the issue, and it became also the corporate book. And that became self-fulfilling. But actually there was a problem in the corporate book, and we hadn't seen that, and we should have seen that, and so a whole series of mistakes that we made. And
now we've made readers less keen. onto the new vehicle, which is an investment trust that Phoenix has taken over the management of, right?
Yes.
Tell us about that.
So it's been a problem over there. So we opened the fund again in 2009 and went out to try and find investors. And we found investors for the offshore fund. It's easier to find institutional investors, but there's lots of people who would like to invest with us who can't because they have smaller amounts of money, or because it's offshore, it's unregulated, so we can't deal with them. We can't deal directly with a retail investor and promote an offshore fund, or people need daily dealing, or they need something that means that the offshore fund's not suitable. Yeah. So and then someone approached me about doing an investment trust. Said, why don't you do one? There aren't enough stock picking investment trusts in the UK, or they've all gone. So we looked at doing a new launch, and that's quite not a lot of work, but it's trying to get everybody interested at the same time. And what's always appealed to me is sort of the Ian Rushbrook way of doing things, is set up your store in a certain way that you do it this way, and gradually attract the right sort of investor to you.
Ian Rushbrook, for readers who don't know, was the Personal Assets Trust manager for a long time.
And I thought and I'd come across him a long time ago, even before I started Phoenix, and just a very eccentric character who didn't bend to any kind of investor demands, and just said, this is what I do, and you're welcome to join. And I suppose.
And they did.
And they did.
Yeah.
Because ultimately he did a good job, and he explained what he was doing, and I suppose that's what we found in Phoenix. Over the years, we've attracted the right sort of investor. It's really important to have the right sort of investor. So in the credit crunch, at the very peak to trough worst time, we had a 50% drawdown in the UK fund. We didn't get £1 of redemption. Not £1 redemption. I didn't get any complaint letters.
Very loyal investors who understood what you were trying to do and didn't mind when things went wrong because they figured it would come back.
And we said, look, we're buying lots of cheap stuff. This is going to be wonderful. And ultimately, it was wonderful, but it was painful first. And I suppose that's what goes. And we want the same type of investors, people who understand it's bumpy. Okay,
so you decided not to launch a new investment trust. So you've bought somebody else's failing investment trust, not bought but taken over somebody else's failing investment trust.
So I said on the way out, if there was a trust that was already set up and available, and then Aurora is a trust that where effectively it was going to get wound up, where a long period of underperformance meant that people were throwing in the towel, and it was going to be wound up, and we've effectively been appointed the manager of that, and we've sold but it was a UK only listed UK investment trust. So we've sold that portfolio and we've been replacing it with the UK fund portfolio that we have.
So the same portfolio as the Phoenix Trust?
Yes.
Yeah.
There are some things that we
Phoenix
can't
fund.
put exactly in because if we own 40% of CPP, we can't buy another share of it. We'll have to bid for it. But so there are some differences. But yes, it's just the same portfolio, same stocks.
And it's called Aurora. Was called Aurora. It's still called Aurora.
Still going to be called Aurora.
No temptation to change the name to get rid of its horrible track record.
No, I mean there's been talk about that, but I think hopefully we'll get it associated with a good track record.
Okay. And how big is that trust at the moment?
So it's £17 million.
17.
17.
17.
17.
Yeah, so that's a small trust.
It's a small trust, so we are doing a new capital raise. We'll sell the treasury shares, and we're going to raise 50 million. Our goal is to get it to 100. I mean, 17 is 2 million. We're not going to operate a
You're not going to make
trust
any
that
money
small.
in it from starters, are you?
Sorry?
You're not going to make any money from it for starters.
Well, the structure we have, we don't make any money anyway, unless we outperform. But no, we don't. Well,
Okay,
we've always
go.
known it needs to be 100 million to be able to be effective.
Yeah. Let's go back to that fee structure then. You don't make any money unless you outperform. How does that work?
Okay, so we are earning not a penny. There's no management fee.
Not even an admin fee to cover
No,
the costs?
no,
Nothing?
nothing.
So it's going to cost you to run this
It's
thing
going to cost us,
unless
right?
you outperform.
And we have a director nominated, and he won't get paid. So
You have a director nominated.
So we've directed somebody from Phoenix is going on the board, not myself, but another member of the investment team, another director. He won't be getting paid. So we will not take a pound to Phoenix out of the investment trust. So yes, it will cost us to run it. But the fee structure is we will get paid 1/3 of the outperformance. So and we'll get paid in shares of the trust, and for 3 years they will be restricted. And if we give back any of that performance, there's a full clawback. So if after the end of the 4th year we don't have that outperformance, then we lose the fee. So we can only make money if we generate genuine alpha, and that hopefully is the most aligned that we could get the fee structure.
The rest of the fund management industry are not going to like you for this.
No, he won't catch on. I'm pretty sure he won't.
He won't catch on.
He won't catch on.
Well, Neil Woodford's structure with Patient Capital is sort of vaguely
Yes.
It's similar, isn't it? Although I think there's an admin charge in that.
He covers his costs. But he's raised loads of money, so that's not going to be a lot of.
Yeah.
But I think it's an absolute performance fee. So
right. So it's slightly different.
So he would get. So he could potentially earn money even if he underperformed the market. But yes, he has a.
Can you earn even if you have negative relative performance? I mean, someone else loses 20%, you lose 10%, you still get paid?
We get capped, so we can only earn, even on a boom year, we can earn 4%. We can only earn 2% in a down year.
Right.
So we can. So if we lose 5 and the market's down 15, we will get paid for that outperformance.
Okay.
That caused a lot of issues in negotiating.
And that's a big conversation because that's difficult for an investor, isn't
Yes.
it? He lost me money, but he still technically outperformed, and it's that kind of relativity that very often the retail investor, the ordinary investor, can find confusing.
And that obviously again that's held for another 3 years. So if it's not genuine outperformance, then we won't get it. But our view is protecting your money on the downside ought to be as valuable as outperforming on the upside. And we're not going to continue to be employed if we're losing money every single year for 10 years, even if that's an outperformance. We're all finished.
Make you very, very poor because the investment trust still costs to run.
Yes.
Yeah.
So we'll have to pay tax on those fees, even though we don't get them. We'll have to, pay our tax in advance, and so it will cost us. And it's 4 years before we can sell any shares and earn any money. So we've drafted it so that we think it's designed to be fully aligned. We can do very well. By delivering genuine outperformance. I mean, my view is, if I'm an investor and I decide to invest in equities, that's one decision. I should probably just buy an index fund. That's the lowest cost, most simple way to make that allocation decision. And I'll get the returns of equities, index fund or an ETF. So if I decide to make a further step and say, you know what, I want to pick a manager, I want to pick a stock picker, what do I want from him? I want something, or her, I want something in excess of that, what I could otherwise get for nothing or for very low cost, which is the outperformance. So we're only going to get paid if we've delivered that.
If you deliver that.
And anyone can deliver it in 1 year because it's random. So the clawback.
So, but 3 years you think is not random?
4 years.
4 years.
So there's correlation when you do the studies. There's correlation between fundamentals and share prices over. It turns positive at 3 years.
Okay.
But we've outperformed in the past by 8%. So if we do 8% per year, it'll cost 2.4%, which seems like a very big fee, but investors will have got 5% a year.
Yeah. If you outperform by 8% every year over the long term, I don't think anybody will mind at all.
Yes. Now we've had
taking a third of that up. I'm sure you've had no complaints at all on the Phoenix Fund.
No, we've not had.
What are the fees on that, just out of interest?
So we have a 1% management fee. That's because we went with a performance fee only structure to the regulator used to be IMRO, and they sent it back because we had no income in our business plan. And we had performance fees only. So we've had 1% management fee, and we have a 20% performance fee above an inflation hurdle. So that you can get bad outcomes there. We get paid in a downturn. We get our management fee anyway, even on down years.
So actually the fee structure on Aurora is better?
Yes, I think. It's more aligned.
You think so? I would agree, yes.
If we delivered what we had delivered, it comes out roughly the same. Yeah. But if we were average or below average, we don't get a penny, which is not the case with the Phoenix. We get paid just for turning up. Aurora, that won't happen. We will have no incentive just to continue on running the Aurora Trust like in the past, because we won't be earning anything. We'll be better off wrapping it up.
What was the fee on the Aurora Trust before, out of interest? Do you know?
Yeah, it was a percent, but it was of the gross assets, and it had gearing. So, yeah.
And it was a performance fee. Assets, so percentage of the borrowed money as well.
Yes.
And a performance fee.
And a performance fee. A 10% performance fee.
Can you remember? Do you know what the percentage was?
Is it 10% of relative?
10%, but what the management fee was of the gross assets?
So 1%.
So 1% of gross assets.
So it worked out about 1.5%, 1.4 plus a performance fee for our performance. I can't exactly remember the performance fee because they did.
I guess they never got that. That's really shocking, isn't it? I mean, that's very old-fashioned style of charging.
Yes.
And charging on gross assets is not really acceptable in investment trust world anymore, I don't think.
No, that to me that was misaligned, because you can see what would happen is even when you perform badly, you're still actually getting well paid. Yeah. That was a different style of management. That was someone who had a very sort of big top-down view. When you have a top-down view of the world, if it goes wrong on the whole portfolio, and you only do 2 or 3 of those in a decade, maybe, and so you don't get the. I mean, what we do is we do a lot of the same thing again and again. So, our errors get filtered out, and we can learn from them much quicker. So we've made 100 investments in those 18 years. It's much easier to sort of progress and learn if you're just doing stock picking rather than.
What's the average holding period for a stock that you have?
I don't know actually. I know
it's supposed to be an easy question.
I know the average turnover is 7%.
Okay.
So
quite long-term holdings.
It's quite long-term, and sometimes because what happens is some of the transactions in the portfolio are to do with money flows rather than. Yes, so things get taken over. I mean, ideally, we try to buy things that you don't need to sell. Things like house building, unfortunately, you may need to sell. We owned house building, we had to sell it because it's cyclical, and they can get into the wrong capital structures, and you might need to time your investment. I mean, value time, but ideally, I mean, we bought Diageo in 1999, and we still own it. If you can find the right. What our view is that we only buy businesses where the clear return on capital, cash return, is over 15%. So if we've allocated our money to a business where they're earning that, and we're confident with the management, they're redeploying like that, then our job's done. All we need to do is monitor it and leave it alone. Unfortunately, things change, but ideally that's what we're trying to do, just plant acorns, and leave them to compound over the long run. So yeah, the holding period, the longer we go on, the longer it goes up, because things like Diageo are still in there.
Okay. Brilliant. I think we'd better leave it there, but that's fantastic. Thank you so much, and we'll all look out for the Aurora Trust from here.
Thank you very much.
Thank you very much.